On January 12, 2021, GameStop shares were worth below $20. By the end of the month, its shares closed at $325. To put that in perspective, GameStop's market cap went from $1.39 billion to $22.67 billion in 17 days. So how did GameStop's value increase by more than 1,500% in weeks? What does Reddit have to do with it? I'll give you a hint. It's not what it seems to be. And why did their success depend on showing their tendies and having diamond hands? Also, how did Reddit almost cause the financial system to completely collapse? It's crazy that barely anyone is talking about it. And we're starting right now. Welcome to Switchboard, where we uncover the hidden and often fascinating stories behind companies, whether they're flying high or have crashed and burned. For a lot of people growing up, video games were an important part of their lives. GameStop was their one-stop shop for all of their video gaming needs, but it's been struggling for a while, with the stock price in decline for years. It started 2017 at around $25 a share. Through August of 2020, its shares hovered around $5. GameStop had lost 80% of its value in only a few years. So, what gives? Their biggest hits are also the reason for their decline: gaming consoles. For years, playing games on the PlayStation or Xbox meant you would have to go to a retailer like GameStop to buy a physical copy of the game. But slowly, gaming consoles started introducing digital downloads. Now, instead of going to the store and buying a new copy of the hottest game around, you just hop on your gaming console and you buy it online. This has led the latest PlayStation and Xbox both selling disc-less versions of their consoles. They're much cheaper than the regular versions. Digital downloads are more convenient for gamers and more profitable for Sony and Microsoft. Everyone wins except for retailers like GameStop. And then 2020 hit, and it brought along a pandemic with it. Before, you didn't need to go to a GameStop. Now, you couldn't go even if you wanted to. Blood in the water. GameStop is a public company, and the struggles have also been very public. Needless to say, investors have been paying attention. A lot of them believed its price was going to keep falling. To profit off its decline, many investors decided to short sell the stock. Short selling or shorting is when you borrow a stock and sell it. You then buy it back later at a hopefully lower price to return the shares that you borrowed, profiting the difference. Let's use gold as an example. Say you have a friend who collects gold. It's currently worth $200, but you believe it's overvalued and its price will soon fall. You pay a fee to borrow the gold for a month. You then sell the gold to another investor for the market price of $200. You're betting the price will fall. In a few weeks, the market price of gold drops and you buy back the gold for $75. After returning the gold to your friend, you're left with a profit of $125. But shorting can be dangerous as your potential profits are limited while your potential losses are unlimited. Going back to the previous example, let's say that the market price of gold rises to $400. Now, you have to buy back the gold at $400, leaving you with a loss of $200. How much of a loss you take depends on how high prices go. Theoretically, the price of a stock can increase infinitely, which would mean your potential losses can also be infinite. The resistance. While many mainstream investors were not optimistic about GameStop, there were others who thought that it had potential. Enter WallStreetBets, the, shall we say, colorful Reddit community all about investing and memes, not necessarily in that particular order. They described themselves like 4chan found a Bloomberg terminal. As early as 2019, a Redditor was making the case that GameStop was undervalued, but its price kept falling. At one point, GameStop's price fell so much, users on WallStreetBets jokingly talked about the community crowdsourcing a takeover of GameStop. Around the same time, Redditor Keith Gill, who goes by the name Deep Bleep in Value, started to build his stake in GameStop. Gill would regularly post screenshots of his gains and losses from GameStop. He would become the first and most prominent user in the community to show that there was actually money to be made in GameStop. Little did he know he would start a rebellion, the likes of which had never been seen before. The rise of the retail trader. Fast forward a few months to March 2020, and COVID-19 is a thing. At this point, everyone is stuck at home, fearing the worst, and bored out of their minds. So many of them turn to the online world and retail trading. That's when you and I trade securities as individuals took off. There were multiple reasons for this. One, the lockdown. People had infinite amounts of time now that they were stuck at home. Two, government stimulus. They now had extra pocket money. 3. Booming stock market. With historic unemployment, the booming stock market held the allure of helping people to make some easy money fast. 4. Commission-free trading apps. Robinhood and a new class of competing brokerage apps had no fees and were designed to be very easy to use, making it much easier and cheaper for people to invest than ever before. Achilles Heel. In April, a Redditor would alert the WallStreetBets community that GameStop had a crazy amount of short interest. Short interest is the number of shares that have been sold short, but haven't been covered or closed out. 84% of all GameStop shares on the market were being shorted. That is a ridiculous number. For reference, 20% short interest is considered high. They would go on to lay out the case of why now was a golden opportunity to buy into GameStop. One of their main points was that GameStop short sellers were now exposed to a short squeeze, which could be potentially very profitable for Redditors. A short squeeze occurs when a stock increases quickly in value. This forces traders shorting the stock to buy it in order to stop even greater losses. All the short sellers suddenly trying to buy the stock at once increases demand, which causes the stock price to rise even more. To squeeze the short sellers even more, they told their fellow Redditors buying the stock to call the brokers and tell them to not lend their shares to short sellers, thus limiting supply. Because there would now be fewer shares on the market for short sellers to buy, the demand for the remaining shares would go up. This would increase the stock's price. They would be forced to pay even more to buy GameStop shares, which would push the price up even more, creating a vicious cycle. GameStop shares would rise significantly days after the post, but not enough to trigger a short squeeze. What they needed was something or someone to rally around to help trigger a short squeeze. The chosen one. Enter Ryan Cohen. On August 31st, the founder of billion-dollar e-commerce pet retailer Chewy announced that he had acquired a 9% stake in GameStop. Mainstream investors were excited and the stock price rose. But they weren't the only ones who were excited. In their little corner of the internet, WallStreetBets was buzzing with the news of Cohen taking a stake in GameStop. The thinking was that Cohen could help GameStop transform into a dominant e-commerce retailer focused on gaming. His time at Chewy proved what he was capable of. The belief that he could right the ship long-term, increase sales thanks to the pandemic, a strategic partnership with Microsoft, and expectations of a strong holiday sales thanks to the next-gen PlayStation and Xbox coming out contributed to a rise in share prices. The more the stock price rose, the more Redditors bought in, pushing it up even more in the last few months of 2020, setting the stage. It's now January 2021, and we're still knee-deep in the middle of the pandemic. In a little more than a decade, the world has been through not one, but two recessions. The common thread is that the elites get bailed out, while everyone else is left to fend for themselves. Wall Street was thriving, while the average Joe was barely surviving. WallStreetBets saw this and they were not impressed. Users in the community talked about how the 2008 recession had forever changed their lives for the worse. GameStop slowly went from an opportunity to make some money to being an opportunity to stick it to the elites, the short sellers. They wanted them to feel the pain that they had felt. While there were many hedge funds shorting GameStop, Melvin Capital and Citron Capital would come to be the focus of WallStreetBets' anger. Both hedge funds were shorting GameStop, and Redditors were enjoying watching them accumulate the losses as the stock price steadily rose. GameStop was now trading at nearly $40, sparked by the news Ryan Cohen had joined the board. On January 19th, Andrew Left of Citron, who WallStreetBets happens to not like at all, said that he believed the stock would quickly fall back down to $20. This left Redditors infuriated, but thankfully for them, the price didn't fall back down. Instead, this would be the beginning of a historic rally. The joke to take over GameStop was slowly becoming a reality. Within days, many retail investors who had bought into GameStop were making staggering amounts of profit on paper. At the same time, it's important to note that while the Reddit rebellion was built on fighting back against institutions, many institutions holding the stock benefited immensely from its meteoric rise. In fact, 9 of GameStop's top investors, many of them institutions like BlackRock and Fidelity, would watch their shares rise in value by $16 billion. Fidelity, GameStop's largest shareholder, would go on to sell the majority of its 13% stake in the company for a massive profit. But even as the price rose, interest in shorting GameStop continued to increase as well. On January 21st, 140% of GameStop shares were being shorted. This means more shares were being shorted than were literally available on the market. I know what you're thinking. That sounds impossible. Well, it's super rare, but not impossible. Shorting over 100% is possible because shares that have been sold in the process of being shorted can be shorted again. There's no rule saying shares can only be shorted once. Even though short interest was as high as ever, investors who were shorting the stock before GameStop's massive rally were taking a beating. To give you an idea of how bad it got, Melvin Capital had to raise almost $3 billion in emergency cash to help stabilize their operations. Citron Research got burned so bad they announced that they would no longer publish investment reports on shorting companies, something it was famous for. Barbarians at the gate. As GameStop stock started to take off, mainstream media and Wall Street were shocked. Some compared what was happening to the Capitol riots that had taken place in Washington only days earlier. Because beating Wall Street at its own game is clearly the same thing as mobbing the Capitol and descending into physical violence, right? Others complained that what WallStreetBets was doing was market manipulation, even though hedge funds would regularly go on TV and talk about stocks that they had a position in, which could potentially move its price up or down. As Glenn Greenwald would later go on to point out, they're not upset by the behavior, they're upset by who's doing it. Even Elon Musk would get in on fun, tweeting GameStop. On January 27, GameStop would close at a high of $347.51, protecting the rich from the poor. That same day, Robinhood and some of its competitors would block users from buying 12 different stocks, including GameStop. But crucially, you could still sell the stocks. Investors buying GameStop had all the momentum, but suddenly Robinhood blocks all users from buying the stock. Now, Robinhood isn't the stock market itself. It's just one of the multiple platforms that allows retail investors to buy stocks from the stock market. So while Robinhood and some of its competitors were blocking retail investors from buying particular stocks like GameStop, these stocks could still be bought on the stock market itself. The fear and uncertainty around what was going on with GameStop led to investors selling the stock in huge numbers. Remember, selling was still allowed. This led to a sharp decline in its price. On the other hand, short sellers could still buy the stock from the stock market as the price was falling from the rapid sell-off. Investors buying GameStop no longer had the momentum on their side. The massive amounts of panic from investors who owned GameStop caused it to plummet to less than $200. Investors holding GameStop would suffer losses of more than 40% in a day. Robinhood CEO Vlad Tenev was later asked on CNBC about what led to restricting the stocks. He replied that Robinhood has a lot of financial requirements, some of which fluctuate a lot based on volatility in the markets. Given the volatile nature of the markets at the time, those requirements can be substantial. The host replied that it sounded like to him that Robinhood had a liquidity problem. Vlad replied no, and that this was done proactively. One day later, Robinhood would raise $1 billion. In an interview alongside Elon Musk, Vlad will later go on to say that their clearinghouse, which process and settle Robinhood's trades, increased deposit requirements by an order of magnitude to $3 billion that week to protect themselves from possible losses because of extreme market volatility. In response to the increased requirements, Robinhood restricted buying in more than a dozen stocks, including GameStop, which helped lower the deposit requirements to $700 million. Days later, they would raise another $2.4 billion. So yeah, it looked like they had a liquidity problem, but it's not that simple. Weeks later, Vlad would go on to clarify and explain things further. Liquidity problem is a very loaded phrase in the financial services. It brings up memories of Lehman Brothers at the height of the 2008 recession, where a business is literally considered inoperable. At the time of the CNBC interview, Robinhood did not have a liquidity problem. They met all of their deposit requirements. The new capital that was raised, the $3.4 billion, wasn't to meet their ongoing deposit requirements, which they had already met. Instead, the new money was to help relax restrictions around the stocks and also to help build a cushion going forward to help with the rapid growth that they were experiencing. Rather than help with the present, the new capital was mainly meant to help with the future. Social media made trading stocks, and by extension Robinhood, go viral. The issue was that they weren't ready for all of that extra attention. The problem wasn't that they had liquidity issues, but rather that they didn't clarify what was going on. The lack of clarity was instead seen as a lack of honesty. This led many to be wary of what Robinhood was saying. The fact that only a month prior Robinhood was fined $65 million didn't help their credibility either. Let's just say when they say you can invest for free, they don't actually mean free, but that's for another video. This lack of credibility led many to speculate that the decision to restrict trading was related to Citadel Securities, one of Robinhood's biggest customers. Citadel's sister hedge fund was one of the institutions that had bailed out Melvin Capital. For some, the coincidences were too much. They believed that Robinhood was blocking trading to help take the pressure off the hedge funds, which were suffering from massive losses due to GameStop's rapidly rising price. Users were so furious at Robinhood that they flooded the App Store with 100,000 one-star negative reviews. This brought Robinhood's App Store rating down to 1 star. Hours later, Google would remove the majority of the 100,000 negative reviews, leaving Robinhood with a 4-star rating. Democratic and Republican politicians alike were outraged at platforms like Robinhood for blocking retail investors from buying stocks. Congresswoman Alexandria Ocasio-Cortez tweeted she would support having a hearing to get to the bottom of what had happened, while Senator Ted Cruz retweeted her in agreement. A hearing would be scheduled to be held in Congress on February 18th over the GameStop saga, with executives in attendance from Reddit, Citadel, Robinhood, and more. Federal probes would also be launched to investigate whether any laws were broken regarding the GameStop rally. On January 29th, GameStop would bounce back to $325 a share, but then would proceed to go downhill from there, having lost its momentum. Platforms would slowly start allowing investors to buy GameStop and other restricted stocks, but it came too little, too late. By the end of January, investors and hedge funds that were shorting GameStop would go on to lose more than $20 billion. GameStop's short squeeze success inspired investors to seek out other heavily shorted companies and to squeeze those short sellers. Overall, short sellers were sitting on losses worth an estimated $91 billion. Because they had lost so much money in shorting stocks, investors had to sell a lot of their winning stocks to offset the losses. This would cause a general dip in the market. The breakdown. Thomas Pettifree, founder of Interactive Brokers, a Robinhood competitor, would later raise the alarm on how close GameStop came to crashing the financial system itself. We were frighteningly close to the entire financial system collapsing on January 28 when GameStop had 50 million registered shares. At the same time, we had 70 million shares short and 150 million shares short via short call options. If the call options had been exercised, the shorts would have had to deliver 270 million shares while only 50 million shares existed. As the rules are today, the long broker, if he can't get the shares, he has to go into the market and buy the shares at whatever the price is. That could have pushed the price further up into the thousands. When that happens, obviously the shorts cannot pay. They default on the brokers default on the clearinghouse, and the whole thing is a huge mess that's impossible to untangle. While Robinhood and its competitors' decisions to restrict trading was to protect themselves, it seems it may have also ended up protecting the financial system itself. The secret to WallStreetBets' success. Hedge funds pumping millions of dollars into a stock is one thing, but how did WallStreetBets manage to mobilize countless Redditors to all get behind GameStop? The secret lies in showing their tendies and having diamond hands. Showing their tendies. Tendies is a term used to describe gains earned from an investment. It comes from the phrase chicken tenders. Remember Keith Gill, the Redditor who started buying GameStop way back in 2019? Well, he became something of a celebrity on WallStreetBets. Beginning from 2019 when he started buying into GameStop to when the stock skyrocketed, he regularly and consistently showed his tendies. His tendies would serve as social proof that there was money to be made in GameStop. As the stock price kept on pushing up, other Redditors began to believe that GameStop was on its way up and was worth buying into. The more Redditors bought in, the more it would push the stock up, turning it into something of a virtuous cycle. As more people bought in and the price kept going up, they too would start to show their tendies. This meant there was now even more social proof available, which would help convince even more people that GameStop was a stock on the rise. At this point, FOMO, or the fear of missing out, would take over. People would buy in because they did not want to miss out on the rocket ship that was GameStop. Having diamond hands. It's about how much risk you can stomach. If you have diamond hands, you are ready to hold the stock no matter what, until your goal is achieved. Despite the potential risks and losses you may face, Redditors had two goals. One was to push GameStop as high as possible and make as much money as possible. And two, make the elites, the short sellers, suffer. As GameStop rose, Redditors would show their tendies to their fellow Redditors and encourage them to also have diamond hands. This social proof that their fellow Redditors also had diamond hands was critical because it showed them that they weren't the only ones holding onto GameStop, and many in the community believed that the best was yet to come. Another reason that some people held was because they wanted the short sellers to feel the pain. Theoretically, if they sold the stock en masse, the price would drop and it would take the pressure off the short sellers. They didn't want that. The fact that everyone else believed there was still upside, along with the desire to make Wall Street suffer, helped individual Redditors hold when they might have otherwise sold. Again, the fear of missing out would kick in. They didn't want to sell their shares too early and miss out on making even more money. Smoke and mirrors. So yeah, showing your tendies and having diamond hands was critical for WallStreetBets to help start the epic GameStop rally. The question then becomes, do retail traders have the type of capital needed to push GameStop as high as it did on their own? Turns out, maybe they don't. Let me explain. According to Bloomberg, retail traders only account for 20% of all stocks traded in the market. While 20% is a respectable number, it's still not that large. JP Morgan's data showed GameStop wasn't even in the top 10 stocks bought by retail investors in the month of January. It was number 15. If retail investors were actually buying enough of GameStop to move the price as high as it did, then you would think GameStop would be in the top 10. Finally, during the week that GameStop mania was at its height, retail investors actually sold more GameStop shares than they bought. If retail traders were the only ones in the market, then the fact that they sold more shares than they bought would have meant that GameStop's prices would have dropped, but it didn't. Instead, shares reached all-time highs. So if retail traders weren't the driving force behind the rise of GameStop, who was? The answer, hedge funds, but it's not as simple as that. Let's simplify and put hedge funds into two categories, those shorting GameStop and those that didn't. For hedge funds not shorting GameStop, they are out to make money. For hedge funds shorting GameStop, they are just trying not to lose any more money. It's possible hedge funds bought shares of GameStop that would have otherwise been available for short sellers to help cover their positions. This would decrease the supply of shares available and increase the prices of the remaining shares. The short sellers would be forced to pay even more for them, thus creating a vicious cycle. One hedge fund went on to make nearly $700 million in profits. Turns out short sellers did get squeezed, just not by Redditors. If you want to learn more about the fall of GameStop, check out the video over there. And if you haven't yet, make sure you subscribe so that you don't miss out on more videos like this one. Thank you so much for watching, and I'll see you next time.